right, so you are welcome back to the channel. If you are new here, my name is Flavia, and then if you are here wondering how to start your options journey, you are thinking about the strategies involved and what strategy will work for you, and you are concerned about how to manage your risk, how to protect yourself on the stock market, and how to make profit. Sit tight because this video is for you. Remember, we said an option gives you the right, a call option will give you the right, but not an obligation to buy 100 shares of a company at a particular time and then date. A sell option is the opposite of a call option. It gives you the right, but not an obligation to sell 100 shares of a company at a particular date and then price. Remember, in options, the price, we always refer to it as the strike price, and the cost of the option we refer to as the premium. Don't forget. Right, so we are going to strategy number 1, and this strategy is called the covered call. Now, a covered call is a call option where you are selling a call and you are saying that if the price of your shares, you already own 100 shares of a particular company. So what you are saying is that if the price of that share gets to a certain price, you will sell your 100 shares that you own. Okay, so here you should be owning that stock. You should have 100 shares that you are owning before you can sell this type of call. Okay, and then number 2, it means that once you are saying that you will let go of your shares when the price gets to a certain level, fine, you are taking an insurance and you are going to be paid a premium. So that is the number 1 benefit. You get premium, you keep. Whilst you are waiting for the price of the stock to rise, and then you are also waiting for the time to get there. Then, if the time gets there, so you are saying that, okay, by Friday, I'm ready to sell my Meta shares. If Meta shares gets to 500 shares per share, because you already have 100 shares of Meta. Now Friday comes and then Meta shares gets to 500. Unfortunately, you have to sell your shares. And then, fortunately again, you make profits on your shares. So if you anticipated Meta shares to have gotten to 500, and then currently Meta shares is 450. Now Friday comes is 500. You have made $50 per share on your 100 shares. So you are benefiting 2 times. You have taken premium because you offered to sell the call, and then number 2, you have benefited from the price increase of your shares. This is it. All right. So we get to the second option, and the second option is cash secure put. Here, you are selling a put. And when you are selling a put, what you are telling us is that you are ready to buy. Let's use the same Meta example. Now Meta sells about, and this is just for an example. I'm not saying that the price of Meta is really 450. It's just for an example. So you are saying that when Meta is being sold for 450 now, and you are saying that if Meta, okay, gets to 400 per share, you are going to buy 100 shares. So it means that you are looking at a $50 drop on Meta price. What happens is if Meta price gets to 400, then you'll be called to buy the shares. So in this kind of, cash secure put, you must have the amount to be able to buy 100 shares of Meta at $400 per share. Otherwise, you can't take this type of strategy. Okay? Then let's look at the third one. And the third one is a long call. Usually a long call is when you anticipate that the price of a certain stock will gallop. So you want to take advantage of it. So you are agreeing to buy 100 shares of the stock when it gets to a certain, so you could even take 1 year, 2 years, and you are saying that you want to buy 100 shares when it gets there. But today, what you are doing is that you are you are paying a premium, and then you are anticipating that when the price gets there, you are going to buy 100 shares. And so you are going to enjoy an unlimited amount of profit, and just by investing very little amount of money in terms of premium today. Okay, we look at the fourth strategy, and the fourth strategy is a protective put. Okay, so a protective put gives you the right to protect your shares. So what you are saying is that you are entering into this put, and then you are saying that when the price of your shares, here you must have 100 shares that you are owning, but you are so afraid that the markets, the price of the stock may go below a certain level. So here you want to protect yourself. So you go in there, and then you are agreeing, you get into this contract that when the price of your stock gets below a certain level, you will sell it. So what happens when the price gets there? When the price gets to your anticipated price, you can sell your shares to cut down on your losses, right? That is it. Now, the only thing is that definitely there will be some losses because it has fallen below a certain level. But then at least you have, because of the option that you bought and you took premium, so you are somehow protected. Okay, and that's why we call it a protective put. So you see, in options trading, we have so many strategies that you can use to protect yourself. If you look at the covered call gives you, the protection. You already have your shares, and then you are going into an option, and then you have already taken a premium. Now you are waiting, and you are saying that when the prices rise, you will sell. There's nothing to lose here. Okay, so the 4 strategies that I have laid out, we should look at it. Look at what, for people who are beginners, maybe you may not be able to own 100, people who have small accounts, I should say, you may not be able to own 100 shares on a stock that you can be selling puts. But selling put is almost like it guarantees you money and protects you on the market, where at the end of the day, you hardly would lose any money. Okay, but you see, even if you will lose, but it gives you, with the amount you will lose on your options are very, very minimal. And this is what makes options trading very, very attractive, especially when you have a lot of money in your account that you can buy shares, and then you can buy good company shares. You can buy 100 shares of good companies. You can be selling, calls, and then you can be selling puts on the shares that you own, and then you stand to gain a lot of profit whilst you manage your risk, and then you run home with cash. Right. So subsequently, we will explore how we can practically take our trades, as I mentioned before in previous videos. So you would want to subscribe to this channel. You would want to like if you have found any value in this video, and then hit the notification bell so that you don't miss anything that we are going to be sharing in this journey of trading stocks and options on the stock market. Until we meet on the next video, once again, I wish you the blessings of God. Stay trading and stay happy. Bye.